The 2022 housing crash is shaping up to be even worse than 2008. And in today's long form video, I'm going to introduce you all to a macroeconomic expert who's going to give you his insights on the state of economy and just how bad things could get. With that, I'd like to introduce my special guest today, Adam Taggart. He's the founder of Wealthion, a very prolific YouTube channel that has interviews with dozens and then actually hundreds of macroeconomic experts. Welcome to the Reventure Consulting YouTube channel, Adam.
It's a pleasure to be here, Nick. Really enjoyed having you on my channel a month ago. Really happy to be on your channel now.
Glad to have you on, Adam. We had a great conversation last month on the Wealthion channel, and I'm really excited for this one. And a big question that I know is on a lot of my viewers' minds is, how bad is this going to get? This is the theme of the video. Could we see a recession that's worse than 2008 and a housing crash that's worse than 2008?
Worse than 2008 is a really big question. And I don't know if I can say with confidence that it's going to be worse. I think the potential for it to be on a 2008 scale is high enough to not be dismissed. But what's interesting, and you and I have talked about this in some of our offline discussions, Nick, is the systemic instability doesn't seem to be there this time around as much. So in 2008, the big concern there was all these horrible housing loans that have been made were threatening to take down the entire banking system, right? Where like the plumbing of commerce would break. We don't seem to be that vulnerable at this point in time. The banking system doesn't seem to be that vulnerable at this point in time. But we do have a number of factors that could still translate into house price declines by the same percentages that we saw in 2008. Partially driving that, and I think we'll get more into this in the second video that we do on my channel, there are a number of housing markets that years ago vaulted above their 2007 bubble highs and are like 2 or more times that bubble height now, right, even though the incomes in those markets haven't increased nearly as much, right? So there's just a lot more sort of speculative froth in a lot of the prices in some of these markets.
It's a really interesting point that you brought up, because a lot of people say that this housing downturn can't be worse than 2008 because they say we don't have the same level of subprime loans. And you alluded to the fact that some of the debt levels in the economy are better today than they were, particularly consumer debt is better than it was 15 years ago. But then there's other risk factors that weren't there in 2008 that are there today. And particularly, is this related to how much the Federal Reserve propped up the economy over the last 15 years and over the last 2 years, especially, and that actually that level of Federal Reserve support wasn't there in the mid-2000s. So if you take away all the free money, which the Fed is doing, and you increase interest rates, could that be a shock to the system that we almost don't understand yet how severely that could play out?
The answer to that is a resounding yes. Yeah, it is absolutely a shock to the system. And even the folks that I interview every week who really understand this stuff, they knew it was going to be a big shock. So they're not shocked by what's happening so far this year. I think maybe a lot of them are surprised by the swiftness with which it's become as severe as it has this quickly.
In terms of the swiftness, we're referring to like the stock market's down 20%, the housing market's in a correction, Tesla's announcing layoffs. Like this all happened in the matter of a month or two.
Exactly. Or, we could say the past 5 months because
Right.
We're just in early June right now. But yeah, if you were talking to somebody at the holidays of last year, it was awesome.
No way would that stuff happen by May or June.
And to your point about the Fed being kind of a key agent here, that is absolutely true. First, they made the cost of capital ridiculously cheap, cheapest it's ever been in our lifetimes, and in some cases for centuries. And that made it really easy to buy houses at higher prices, right? Because the debt burden was so low and it was pretty easy to get those loans. The Fed was also buying tens of billions of mortgages every month. It's part of its quantitative easing program. So that was propping up the ability of the mortgage market to absorb these higher and higher prices.
That's a great point, Adam, because a lot of people don't know that. The Fed printed money by actually buying mortgages. That's how they printed money. And they own, I believe it's almost $3 trillion in mortgage-backed securities. So if you went to buy a house over the last couple of years, there's a good chance your mortgage was sold to the Federal Reserve. And a lot of people don't know that. And they're stopping that, correct? They're no longer buying mortgages?
They are no longer buying mortgages, yep. And we're now entering a period of tightening. We were in quantitative easing. We're going into quantitative tightening. The Fed is basically said, look, regardless what I was doing before, I now got to bring inflation under control. So what I got to do that is I've got to make people feel less wealthy. When the Fed talks about bringing down demand, that's what it's talking about. So by raising the cost of capital and the things we've talked about, What the Fed is doing is it's engineering these lower stock and bond prices. It's engineering these lower housing prices. It wants to do that because it wants people to feel less wealthy, buy fewer things, and therefore begin to bring down the buying pressure that's been creating all this inflation.
So
now,
the Fed, let me just jump in here.
Yeah.
The Fed wants, like Jerome Powell, you're saying that he's thinking he wants the stock market to go down. He wants the housing market to go down because he views these things going down as a means to dampen demand, consumer demand, and that will dampen inflation. Am I reading that right?
That is exactly right. Now, you may never hear those exact words leave Jerome Powell's lips, but that's essentially what he's saying when he's saying, I am focused on bringing demand down. You've probably heard about the term the wealth effect, which is what the Fed has really been stoking for a lot of the past 20 years. Is, hey, when people feel wealthier, they go out and they buy more stuff, and that drives more economic growth, and the economy grows, and we all benefit from that, right? But when things get too hot, it really is the Fed's job, the way the system is currently constructed, to be the adult in the room and to remove the punch bowl, like basically to try to get the party to end early. The Fed was very poor party chaperone for the past 10/20 years. In fact, they're kind of spiking the punch as the party was really getting going, right? Now they are finally stepping into their true role, but the role is supposed to be. And they're really doing it reluctantly. They're doing it simply because inflation is forcing them to.
So
right?
That's the game changer, right? Because a lot of people, and we're going to get into this point in a second, a lot of people are saying, I see it in the comment section of my videos, that, they say that the Fed and Jerome Powell, as soon as things get tough, as soon as the downturn gets serious, they say the Fed's going to print money again, and this is all going to go into reverse. But you're saying that inflation is the game changer. It's a kind of a new paradigm where it's not so easy anymore for the Fed to just say, we're going to print money.
Exactly, Nick. It all comes down to inflation. So the Fed has been able to be extremely generous over the past couple of decades in terms of how it stepped in and goosed the economy, because its efforts haven't really stoked inflation, at least not the way that the Fed measures it. What's happening now is when inflation gets out of control the way it's begun to, it hits everybody across the economy. Right. So it is the fastest way for an incumbent to get voted out of office. So it's got inflation right now has all of Washington, up in arms, focused on the Federal Reserve, saying, look, we're going to get clobbered in November, during the midterm elections. You got to do something to bring inflation under control.
So there's a political willpower to bring inflation under control. And I think a lot of people don't understand this, is they think that the political willpower is still on the side of reaching full employment or keeping the economy going. But when I see polls, it seems like Americans care a lot more about inflation. Something like 80% of Americans care more about inflation than they do the unemployment rate right now. And so you're saying that's making its way into the decision-making among Joe Biden's administration and the pressure he's putting on Powell. So you're saying there's a political willpower to get rid of inflation. That's going to mean maybe, at least in the short term, the next 6 months or so, this is going to be the path forward.
I think absolutely. And, I talked to a number of people who either work at the Fed or have worked at the Fed. They basically say that the Fed is supposed to be an independent institution. And they say, it's a lot of hogwash if you actually work there. But they know for certain right now that the Biden administration is just pummeling Jerome Powell and the rest of the staff there at the Fed to do everything it can to bring inflation under control. And we just saw last week that Biden invited both Powell and Treasury Secretary Yellen to the White House. They didn't release the transcript, but it's very clear that what he was doing was turning the screws to say, guys, I don't know what you're doing, but you got to do more of it to get this stuff under control here, right? And so the reason why this is also important, again, back to the housing story, obviously, the more that inflation rages and the more that people's household budgets get squeezed, the less they can afford. That makes sense. But the more that the Fed steps in to depress demand, what it's doing is it's causing people to spend less. So there's less spending in the economy. We talked it being 70% of GDP. So less spending in the economy means less economic growth, right? So companies make less. And the danger of this is that you start pushing the economy into recession, so that companies actually switch from making profits to starting to make losses. And then what can happen from there, and this goes back to your question about 2008, well, if that's what happens, what's the cascade effect in terms of, companies starting cutting people's wages, letting people go, et cetera. And if that starts to happen, how bad does it get?
That makes sense, Adam. That's a great point. And I really resonate with the idea that the US government is not going to have the same ability to rescue the economy this time. If you take a look at the government debt to income ratio 15 years ago, it was half what it is today, meaning there isn't as much meat on the bone for the government to come in, which means there's going to be less rescue efforts, less stimulus checks, and a deeper recession potentially. But another thing I wonder is a topic of malinvestment. And this is something I've heard you bring up before, that due to the low interest rate economy we've had for the last 2 decades, there are potentially a lot of jobs and a lot of companies out there right now that are hiring, and they're hiring a lot of people, but they lose money, and that heading into a recession, we could see an abnormally high level of companies shutting down and people getting laid off in a way that people don't expect. Can you touch upon that point of malinvestment and how potentially that creates a situation in 2022 that didn't actually exist in 2007 or 2008?
So when you monkey around with the cost of capital, with the price of money, you create distortions, right? And that's really the game the Fed has been in. And so when you can get access to money at a cheaper price than a fair market would value it at, well, you get as much money as you can and you put it into anything that you think could generate a potential return. And you're not too worried, about whether you get a big return or a small return, because the cost of debt to you is so darn cheap. You don't care.
Profits don't matter. Would it be fair to say profits don't matter as much in this type of environment?
Well, they don't matter as much as long as you're getting the appreciation that you want, right? And when capital starts sloshing around, what tends to happen is it goes into one area, and as more capital becomes available, more of that goes into the same area and the price goes up. And then people say, oh, look, this area is appreciating, so I'm going to put more capital in it, right? And you begin building this kind of self-fulfilling prophecy where asset prices go up because more people are chasing that return, right? And again, as long as money is plentiful and cheap, this phenomenon goes on. And this is essentially what creates an asset price bubble. And what that's allowed is it's allowed asset prices to get to levels that they had no business being at, but it's also allowed a lot of companies to be able to survive when they shouldn't be. So when you were sort of referring to earlier in your question about companies that we call zombie companies, where they've taken on so much debt that they have to keep borrowing debt to be able to meet their debt service obligations, which they can do as long as debt remains plentiful and cheap. But once the cost of that debt begins to go up, as it is now, and once the availability of that credit begins to shrink, as it's doing now, those companies quickly get to a point where they can no longer meet their debt service payments, and then they quickly fall into insolvency. I think it's estimated like 20% of corporate America is a zombie company here. And we could have a cascade of failures across, at the very minimum, this sort of bottom tranche of corporate America. But also, if we get to the point where that's happening, the majority of corporate America is having some issues as well. And so they may not be laying off as deeply or as violently, but they may be in layoff territory. And again, that's where we could begin to see sort of this type of 2008 vaporization of value in assets, whether they're financial assets like stocks and bonds or whether they're assets like real estate. And all that, like I said, as that value kind of vaporizes, the flow of capital begins to really constrict. And that is what, at the end of the day, housing depends on.
That's right. Housing is a debt-driven instrument that, as we're seeing already, is very sensitive to increases in interest and mortgage rates, which are plunging the housing market into a downturn as we speak. And what has me worried is that this is just the start, right? We still have an unemployment rate in America of 3.5% at a record low. And we're already seeing a downturn play out in the housing market. So then what happens to the housing market if all these things we're talking about with malinvestment and zombie company layoffs come to fruition? It's going to mean that the housing market has very far to fall. And I know a lot of people watching this are going to say, well, no way, this can't happen. We can't see 2008 level declines, but I think we can, because you're laying out a picture here which says that the underlying strength of the US economy is very suspect. And these are the early warning signs. And that, an interesting question to ask is, when are these early warning signs going to start transitioning into more obvious warning signs? Like, let's just say some of these tech companies that don't make money shutting down. Let's say a housing market like a Boise, Idaho, being down 20% and that making national news. When do you think, if you had to guess, like what's your gut telling you, when are we going to start to see the early warning signs transition into, major, very loud indicators of a downturn?
First, you see job freezes, right? They just say, we're not hiring anymore. right? That's their first line of defense. I'm just going to read you real quickly. Right before we get on here, I did a quick Google search of hiring freezes. So we've got Microsoft, we've got NVIDIA, we've got Lyft, we've got Snap, we've got Uber, we've got Coinbase, we've got Salesforce, we've got Meta, we've got Twitter. Those are some of the biggest drivers of this nation's tech engine that are already at the hiring freeze. That's their first line of defense. Then you see them cutting bonuses, cutting hours, or letting go all of their contractors, right? I would call that kind of like stage 2. And then stage 3 is layoffs. Okay, we got to start dumping people here. I can't talk as much to, bonus cuts and whatnot, but we are beginning to see layoffs, right? Elon Musk, just sort of shocked the world the other day when he tweeted out, all right, Tesla, we're not hiring anymore. We probably need to fire 10% of our workforce. I'll give you a chart here. Hopefully you can display, Nick, but it's a tech layoff chart. You'll see here that these layoffs went through the roof back in March and April of 2020, totally understandably when we were shutting the economy down. They pretty much went away for the next year and a half, but now they're coming back with a vengeance. If you look at the May data here for May 2022, it's back to the level that it was in like July of 2020. We're seeing a fast acceleration of the data beginning to head in that direction.
Can you let my viewers know, do you think we are already in recession here, entering the summer of 2022? Or if not, do you think that recession is going to come by the end of the year?
I think the answer is kind of both. And I'm not trying to be wishy-washy. I'm just saying, I think that there are parts of the economy that are already in recession. And, not for nothing, we had a negative GDP print for Q1 of this year. And right now, the estimates, the Atlanta Fed, their GDP Now service estimates what it thinks the coming quarter is going to be. And they've been ratcheting that down. I think it's just a little bit over 1% right now.
That's
and we still have the rest of the month to go. So that could dip negative. And technically 2 quarters in a row of negative GDP growth is sort of an official recession. That's what they base the official definition of recession on.
Like we're almost out of official recession. We're close. We are close. Based on the traditional definition.
Yeah, exactly. If you look to where the puck is heading economically, particularly if you look at where the consumer is headed, and consumer spending is about 70% of total GDP, that's really the important thing you got to look at. And if you're looking at the consumer situation, it's really not very optimistic, Nick. In fact, it's deteriorating pretty rapidly here. And there are a number of factors right now that are impacting the consumer. And, we sort of talk sometimes about like a 1-2 punch when you're getting beat up and caught by surprise. This is more kind of like a back alley beating. I mean, this is just
yeah, I don't mean to laugh, but unfortunately, I think that analogy is accurate. And we're going to get into that data that you have on the consumer in a second. But I just want to explain to people real quick who are maybe more interested in the real estate market than the macroeconomy, why this is an important discussion. Because you have to understand what goes on in the housing market is ultimately a function of what's going on in the real economy at the end of the day. And so if the American consumer, who supports 70% of our GDP, is starting to weaken, that's going to mean less consumer spending. Potentially, that's going to mean layoffs at businesses. If people get laid off at their job, they're not going to be able to buy a house. They might get foreclosed on. So there's all a trickle-down effect. So understanding the housing market, to do that properly, you really need to understand this macro data, specifically on consumer spending. So I'm interested to see, Adam, what are we seeing? What are the indicators that the American consumer is getting ready to tap out and say, I'm not going to spend any more money and we're going to have a downturn?
Great. Well, everybody strap in here. I just want to underscore what you just said there, Nick, is if you care about the housing market, it's really all about flows of capital, right? So you have to ask yourself, okay, so what's going to happen to the flows of capital entering into the housing market? Are they going to be going up? Or are they going to be going down? Multifactorial equation here, but a big part of it comes from what consumers are able to afford and how much capital they have available to them. That's what I'm going to dial you all through here right now. So I would say at a very high level, the big thing I want people to take away from this is that consumer households are getting squeezed. And they're getting squeezed in a way that they haven't been for a long, long time. Specifically, inflation is going up, right? So cost of living is going up. At the same time, the cost of capital is also going up. And that matters a lot in real estate, right? Because as mortgage rates become more expensive, the consumer can afford lesser house, and therefore prices have to come down, right? So the consumer's getting hit there both by rising cost of all the things they need, as well as rising cost of the capital they need to, do things like buy houses. Now that would be okay if consumer incomes were rising at the same pace, but they're not. So real wages are actually declining in pretty much almost every sector of the economy. So essentially what all this means is that the take-home pay that households are getting is able to purchase them less and less of the things they need. So that's kind of the macro theme here. But now what we want to do is kind of look under the hood at some of the specific factors that are driving that. So I mentioned real wages already, but also this has been one of the worst starts of the year for the financial market. Usually stocks and bonds, you own a portfolio made of stocks and bonds because they're supposed to not be very correlated with each other. So when your stocks aren't doing well, your bonds likely are, and vice versa. So they kind of balance each other out, right?
So you don't get killed all across the portfolio. You only lose a little bit here, but maybe you'll gain there.
Exactly. And over time, you should hopefully make more on average. And that's how a well-constructed portfolio performs. This year, 2022, is one of, if not the worst start to the year on record for the stock and bond markets combined. Bonds are down a little over 10%. The S&P is down about 15%. The NASDAQ is down over 20%. We'll talk about housing in a second, but other types of asset classes out there. I know you have a younger crowd. The crypto market is down, like Bitcoin's down almost 40%. In addition to people's real wages going down, like they're losing money in their investment portfolios, right? So they're already beginning to feel a little bit poorer here, right? So housing prices are cooling fast. There was a headline here from Yahoo Finance quoted by Mark Zandi, who is one of, I think, the more conventional economists out there. He's certainly one of the guys who's been the most quoted in sort of real estate articles over the years. Mark all of a sudden is sounding the alarm, saying he thinks that the housing market has, quote, just slid into a full-blown correction. Wow. Right. And he's, referring to things like the fast rise in mortgage rates, the slowing number of transactions, that sales volume is beginning to slow, but also that actual price declines are being seen in the housing market here. So,
I just want to jump in real quick. And we'll get back to kind of the longer term discussion here on the consumer, but it's interesting because I'm noticing that all the mainstream economists, many of whom over the last year swore that we weren't in a housing bubble, whether they work for a big real estate company or a big mainstream economist, they are now coming around to the idea, like you said, that there is a housing downturn. And they're also coming around to the idea that there's a broader recession. And so this is a huge development, right? When kind of the mainstream economic forecasters, who are usually late to the party, once they start joining in, you kind of know that this is happening at this point. So I just want to draw attention to that.
I'm glad you did. So that's an important part of sort of herd psychology here, right? So a herd doesn't bolt a cow at a time, 2 cows later, 3 cows. A herd bolts all at once. It's complacent at first. It begins to get a little nervous on the edges. It gets more and more nervous, more, but it still stays in the same place. And then all of a sudden, 1 cow bolts and they all follow it, right? And investing tends to be a lot like that, where as the conditions deteriorate, you get a lot of people that first just sort of ignore, deride, make fun of the doubters. But as things get more and more, real, more and more people begin joining the chorus of, okay, well, maybe everything isn't quite completely rosy. But it takes a while. You have to get to a tipping point. And once you hit that tipping point, events begin to develop really fast. And the reason why I'm underscoring this is why it's so important at the macro level to kind of understand where the puck is heading so that you can be ahead of that herd. Because once the herd bolts, if you're not well positioned at that point in time, then you're just chasing pricing after that.
That's a great point, Adam. And that's a great analogy you made about the herd psychology, because there's so much herd psychology in the market. And it seems like right now we're just starting to see these mainstream economists, these mainstream forecasters wake up, but it doesn't seem like quite yet we're at that crazed point. Am I right? That we're not yet at the point where people are saying sell everything, where people are liquidating. That's going to come into the future potentially.
No, we're not at all. And that's the problem with just sort of listening to, I'm going to say, the mainstream narrative, and I don't mean to sound like, one of those conspiratorial folks, but just most of the sources that the average person looks to tell them where we are in the story are part of the herd. So, great point. If you listen to Jerome Powell, who's the head of the Federal Reserve, talk, he will tell you that the U.S. economy is strong, and that just a month ago he used the words, "It is in no way vulnerable to a recession at this point in time." But if you look at his actions, what he's doing is he's basically doing an entire 180 from what the Federal Reserve has been doing for the past 10 years, because he's desperate to stop things from spiraling out of control, right? So right now we're kind of almost in that cognitive dissonance stage where you're listening to what people are saying, but you're looking at their actions and saying, those actually two things don't actually match up very much. Let's just use the housing market, right? You don't just go from selling houses at all-time record highs, and then massive price cuts, right? There's sort of a predictable progression along the way that's important because it gives you, some indicators, some early indicators that let you prepare for what's coming, right? So first, what you see is sales volume really begin to dry up,
which we're seeing.
Right? Yep, which we are seeing in a number of markets.
Stage one is sales volume goes down.
Then what you see is you either see incentives, right, for people to come buy. They're not lowering prices yet, but they're giving you, sweeter and sweeter incentives to try to entice you to transact. And it's only after those that you then, when those don't work, then the capitulation starts, right? And then people actually start bringing down prices. So I'm just curious, the housing market better than I. I mean, it's interesting because it's a market by market basis, right? There's some markets where I think they're just at stage one. There's some markets like, say, Boise, which has been a ridiculously hot market, but we're seeing, if you look at the past couple of years, an unprecedented number of price lowerings there now, correct?
You can catch the rest of my discussion with Adam over on his YouTube channel, youtube.com/Wealthion. There's a direct link on the screen in front of you, as well as the description to this video. We're going to be diving even more into the macro economy and especially into the housing market in particular, talking about the cities that I think are going to have the biggest housing crash in 2022. So check out the rest of the interview over on the Wealthion YouTube channel and make sure to become a subscriber over there as well.